disruptive. Okay, so I'm going to get started with the meeting rules. We are recording this, and we'll put this up into our COE forum for later viewing for you or for anybody else who wasn't here and wants to see it. The meeting rules, we have 5 C's, and thanks to Josh for helping us put these together. It makes it easy to remember. We are a confidential organization, so what's discussed here stays here. We're collaborative. We engage. It's not a spectator sport here, so please get involved, raise your hand, ask questions. We're contextual. There's never any selling, no politics, and nothing's ever personal. Because we're the CO forum, we're always cordial, we're always helpful, supportive, and we share our time. And we're also committed to not only yourself, but to your peers. So if you have to take care of something, just put yourself on mute. Actually, stay on mute if you don't mind, if you're not speaking, because the background noise can be disruptive as well. And with that, I'd like to just give a little background to Jay and Mallory, so you know who's here with us today. Jay's going to be doing the delivery of this presentation, and Mallory's going to be the back end and helping us with the support and questions and everything. But Jay has visited us on numerous occasions here at the CO Forum, always bringing us the new updates on the labor data. He serves as the Chief Analytics Officer for LaborIQ. It's a compensation recommendation platform. He's charged with leading the product data and market analysis business units, and his expertise is in analyzing and distilling complex data into actionable insights. It supplies the HR and recruiting industries with the kind of why it matters answers for strategic business and talent decisions. He has been featured in Bloomberg Business, the Wall Street Journal, New York Post, Business Insider, and many others. He's a sought-after speaker for executive groups like ours, and he's also with talent acquisition associations and many media outlets across the country. He holds dual degrees in management information systems and general business from Texas Tech's Rawls College of Business. And Mallory Vachon, I hope I've got that pronounced correctly. Mallory Vachon is senior economist with LaborIQ, and she leads the research and data teams that produce key insights and forecasts related to the labor market. Her main focus is providing clients and general public with sophisticated yet accessible analyses that inform business decisions and an understanding of the labor market and compensation dynamics. As with Jay, Mallory's also been featured in various publications such as Dallas Morning News and Bloomberg as well. She received her PhD, MA, and BA degrees all from Syracuse University's Maxwell School of Citizenship and Public Affairs. Additionally, I'll drop in the chat in just a little bit. LaborIQ just published their LinkedIn newsletter, and I highly recommend that you subscribe to that and follow it because you'll get continued updates from Jay and his team. That said, that's all I'm going to say. I'd like to turn this over to Jay and Mallory to get us started and share some incredible information with us.
All right, Laura, thank you for that introduction. As you mentioned, Mallory will be joining me here. Mallory, if you want to go ahead and share the slide deck, and we'll get underway. While that's happening, a little bit more background on me. So I've been following the labor market for 20 plus years. I spent most of my career in real estate prior to what I'm doing now. I've been part of senior leadership teams for more than probably the last 10 to 15 years. And I've been fortunate enough to, at slots during that period, be part of groups like you're in today. And that peer-to-peer networking and what you can gain, because we all, even if we're in different industries and different locations, we all end up running into some of the same challenges. So really glad that you all are part of the COO forum. Okay, let's get underway. So we're going to try to untangle everything happening in the labor market and things probably influencing your companies. If you want to keep following us, Laura mentioned it. So we're pretty active on LinkedIn in terms of sharing our thoughts of what some of the latest numbers mean, what they might mean to you. Feel free to follow us here or the company as a whole. The newsletter was just mentioned. Before we jump too much in the labor market, I just wanted to explain a little bit of what we do here at LaborIQ. So we're going to talk a lot about what's happening with economic conditions, but we're also, what our product actually is really salary benchmarking. So what should you pay for that role in that location with somebody with a little bit of experience, with a lot of experience? If it's that role in manufacturing or in software, just what's the right rate to help you keep and retain your talent as it relates to salaries. So you can see this is the main visual of the heavy used part of our tool. But it's fueled by a lot of what happens in the labor market. So whether you offer more or less than maybe you did a year ago, it's really that's where this expertise that we'll share on the call actually fuels what those results are. We did create a few documents over the last, I guess since summertime. One of them, if you go to my LinkedIn profile, and we can actually share the link with you directly to this, but helping companies. So one, we mainly work with HR teams. They're the ones that are helping get some of this comp analysis together. We put out a checklist to help your types of companies and HR members work more with the executive teams to get alignment on what might be some challenges in your current process as it relates to setting compensation. So I won't spend much time here, but just know this is a link that we'll share that I think it's a really good thing, especially as COOs, to look at to see kind of where you would rank yourselves on some of these items. So
even grab the QR code right there and get it right now.
Snap it right there while it's on the screen. So we'll that's without further ado, let's get into the presentation itself. I saw already a couple of questions come through. We'll be sure to monitor those throughout. Feel free to ask throughout the presentation. We'll also, we put in a few breaks. So one, Mallory's going to be helping me with this. You don't want to hear from me for the next hour and a half. So we're gonna go back and forth and talk about some of these items, but we'll also want to make sure we pause so that we don't have to save questions to the very end. Let's talk about it in the moment and have some good engagement. We would love that. Let's get into it, Mallory. Labor market overview. Why don't you recap some of the latest figures that we've seen and challenges that we have?
Yeah, so going into 2023, I feel like all of the headlines were around not if, but when there was going to be a recession. And the theme for this year has been continuing to defy expectations. So our projection is that we'll end the year with still normalizing from where we were over the last couple of years as we were recovering with a really amazing recovery. But we're projecting ending the year with 2.8 million net new jobs added, which is really, really solid growth. Maybe more than double what we would see in a normal strong year. An unemployment rate at around 3.9%. So just below 4% is something that we haven't really seen in quite some time. We did end there before the pandemic hit, but normally 5% was considered a really healthy, really tight labor market. And we don't really see us getting much over 4% going through the next year, and certainly to close out 2023. And then finally, as we talked about net job gain. So our business is adding net new positions, but because of turnover, and that's been so elevated, we're projecting around 72 million total hires throughout to close out 2023. So Jay is going to get into a little bit. This year has clearly defied expectations, has been by all accounts one of the strongest labor markets on record, but it doesn't feel that way, especially for everyone.
Yeah, and you saw the headline there from the Wall Street Journal, and I think what's been interesting for us. We'll put information out there that, gosh, these headline numbers at least look great, and then you see the Wall Street Journal article reference of why are people in such rotten moods? And if you monitor some of the things on LinkedIn, and they don't. People's, like what people are saying when they're out there looking for jobs, it's much different. So what we're going to try to do in this presentation is obviously give you some insights, but strike some balance between some headline numbers that look fantastic and what some people or some industries or some locations are feeling, because it's like the completely different side of the spectrum. So we'll start here with what are some of the things causing it, and we'll highlight these throughout. So we'll get into more of the details as we go throughout this presentation. But during the early part of the recovery, you had all of these industries really gaining jobs and bringing them back and so on. And a couple lagged. Those are now the ones that are adding the most jobs, and you're not having as much many new job gains spread across the industry. So we'll have a visual right after this here in a minute. We'll show you that. So it's really, really concentrated, particularly in government jobs and healthcare jobs right now. The other part of that is if you look at specifically over the last few months, kind of from midsummer to now, and if you really break down those headline numbers, you have a lot of part-time jobs being added, not necessarily full-time salary jobs, and especially full-time salary jobs that are maybe a little bit higher on the pay scale. So those are some challenges that candidates are running into when they're out there in the job market. For anybody, whether you actively looked or passively got recruited, contacted by a recruiter over the last couple of years, some of the wages for switching jobs were just out there. Everyone probably knows somebody who got a life-changing type of pay raise when they switch jobs for the last couple of years. I've had people on my teams leave because of those, and I said, go get it while you can. And so those are kind of evaporating at this point. And remote jobs, high, some of the upper end of the bell curve jobs, that's where you've had a bit more constraint on that side. So the jobs that are out there are the ones that are sometimes maybe a little bit lower paying, part-time, and sometimes more on site than they were. And then last bullet there, remote work and how that's impacting things. And we'll have, we won't go too deep into the question just asked by Chuck on the auto workers, but we will touch on that here in just a second. So these are some of the factors I think that are leading to the headline numbers not resonating with a lot of people. But Mallory is we're going to take a second and walk through just what the headline numbers look like overall.
Yeah, so this is just plotting out month by month the headline net new jobs added throughout 2023. So October was just reported last Friday. And we're seeing really very solid job growth, but certainly kind of decline a little bit from where we were at the beginning of the year with nearly 500,000 jobs added. We've averaged around 239,000 jobs, net new jobs per month, which is with October coming in at right around 150K. 200K is really where we were during a strong labor market, maybe through 2015 through 2019. So these are still represent very solid growth. As we'll get into later, there's a lot more below the surface. So let's compare 2023. We look back, clearly 2021 and 2022, as we were recovering, there were a lot of jobs being added. And I think that also has set people's expectations like we're just going to continue this growth forever. And there's a lot of reasons that we'll get into later why that might not be feasible. But when we layer on previous strong labor markets, 2015 through 2019, and kind of the reason we go back to those years is we've pretty much recovered from the Great Recession by 2015, and the labor market continued to be really, really strong right up until the pandemic hit. And if you look at those labor markets and you compare where we are at 2023, it looks really similar and we're right there and it looks really, really strong. There are definitely some headwinds you can see in certain industries though.
And so real fast, Mallory, before we jump into this, and you can leave it there, by the way, either way. One of the things I wanted to mention is everyone's heard this concept of a soft landing. And it sounds really good on paper, like, hey, things don't just fall off a cliff. And overall, it is. But a soft landing doesn't feel soft to a lot of people, a lot of companies, a lot of places. And so I think we're going to be in this period if things can just stay okay and we avoid a recession where it doesn't really fall off, but it also doesn't feel anywhere near like it did the last couple of years. It will feel more like it did before, but again, some of the job gains being perhaps a little bit more concentrated. If 2023 played out like a lot of economists thought, not all, but a lot, that orange line would have fallen off the bottom of the graph. And so while the soft landing might not feel great, it's a lot better than how things could have been. And so the question is really, as we move forward, are we going to be able to maintain something like this, or will we start to slow down a little bit from here more? Yeah. See, treading water. Yeah, winning equals not dying. That's a good. It's a good way to phrase it. All right, let's get into the industries. I'll cover a couple things, and then we'll get a little bit deeper. So, this is if we just look year to date job gains across all the different industries out there. You'll notice the two that I already mentioned. Healthcare and social assistance, which, by the way, it's going to stay at the top for the foreseeable future, probably. We'll explain why in a minute. Government jobs. So government, I would say, really struggled. Like when we look at our clients, we look at really deeper wage trends by industry. Government jobs tend to pay a bit less, and they're really constrained by budgets. So when the market changes, they weren't able to adapt to it. Nonprofits, we kind of saw the same type of thing, and so it was a little bit harder for them earlier on because of some of the salaries being out there for all sorts of types of jobs. Now that the market's kind of that part slowed down, government jobs are coming back more, at least more hiring occurring there. And then you start to see the fall off. So on the auto worker strike, we do believe that's one of the things that is impacting the manufacturing on a year-to-date basis. That number will probably jump back up, over the rest of this year. But you can see that it's having an impact there. Information, Mallory will cover a few deeper points on that, but information is such a wide range of an industry, has to do with software. So I know I saw some people that are either directly or indirectly involved in software. It can have to do with movies and local TV news stations. I mean, it's a really wide range of types of companies. So we'll break that down a little bit more here in a second. So that's a high level. We're going to get quite a bit deeper now, not to cover every single subtype, but this is going to get, these sets of visuals will get more back on why it can feel way, way different depending on who you are. So like on the call today, everyone is experiencing some similar type things, but there might be some folks that are completely way, experiencing something way different than the box you see of the person next to you. Like when I would go speak live in front of an audience, I would look out at the crowd, there'd be a few hundred people, and I go, look, if you look at the people to the left, the right, in front, behind you, each one of you is experiencing something different. Let me show you why. So what we did here is we put this scatter plot together of, we're going to take all the sub industries below this, subsectors is what they're called. And what we're going to look at would be where it falls from the bottom of the chart to the top of the chart. That's how many more jobs on a relative basis that industry has right now compared to this time last year. So an annual growth rate. Going from the left to the right will be the comparison just over the last 3 months. So some industries might have more jobs today, but they have a trend of recently they've actually been losing jobs, and they could end up turning negative year over year at some point. So this is what it looks like when we plot just the national number on there. So it's on the top right, typically where you want to be, and bottom left is usually the bad zone. So let's look at when we layer in all the others, look at where all these like sub industries fall. We have ones way up on the top right, some on the bottom left. Mallory told me right before this when we reviewed this that, the two most dominant quadrants on here are the top right, where they're sustaining. They've added jobs this year. They've added jobs over the last few months. They keep growing. And then the bottom left, they are losing jobs right now. They've been losing jobs for the last year. And that's what's creating this dichotomy within the market. So Mallory, why don't you give some insights of where some specific industries fall on this chart?
So when we layer this on, some of these specific industries probably won't be all that surprising. Leisure and hospitality, performing arts, and spectator sports is basically the best on both fronts. It's been growing a lot. Again, as we mentioned earlier, this is also an industry that has taken among the longest to recover. So there are some industries like tech that did really, really well and then experienced some layoffs with interest rate hikes and such. But leisure and hospitality is really kind of hitting their stride now. And that explains what we were talking about earlier, where there have been a lot of disproportionately many jobs in leisure and hospitality, those part-time jobs, as well as healthcare and government. Mining and logging support activities, again, they hit some rough patches as with oil prices and oil constraints, doing really, really well as prices have gone up. Professional and business, office and administrative services, return to office. I think that's the only thing that needs to be said there. Many people are getting back in the offices, especially for companies where there's no option for remote work. As we go to the ones that are trending positive, this has been a relatively small group over the last several months, but one to highlight there, couriers and messengers. There's been a lot of challenges with supply chain and transportation. So I think this is one that's starting to recover a little bit from some of those previous challenges. Go to the next quadrant, sustained job losses. I don't think either of these will be all that surprising given what's going on in the housing markets. We see retail, electronic and appliance manufacturer, or retail, electronic and appliance stores are among those that have had the worst job growth, both on a last 3 month and year over year basis. And then information. So that includes, as we mentioned earlier, motion picture manufacturing and sound recording. Now that both of those strikes have, I believe, at least in principle, ended, we should see some movement in that industry over the next couple of months as things start to pick up. When we go to the trending negative, we see transportation, scenic and sightseeing. That could just be some wonky seasonal trends. And then back to the entertainment piece, audio and video equipment manufacturing. Again, I think we should see some positive movement over there in the next couple of months. Same with motor vehicles. it should, by the time those auto workers are back at work following the strike, that should start picking up in our jobs numbers probably at the beginning of the year, 2024. And just a little bit more insight into what each of these quadrants are. Really, you can see on the negative side, we've got tech, auto manufacturing or other things related to the entertainment industry. And then on the positive side, we see still, even though interest rates have been rising, construction has been doing pretty solid. And then machinery, manufacturing, and we'll give some other reasons why we think manufacturing actually has some good legs through the next couple of decades. Anything to add there, Jay?
No, I think overall, one, Mary, yes, these are all going to be U.S. numbers. Today, there are a couple other questions that have come through that I'll answer once we get past the next slide or so that we have as a pause for a Q&A. Yeah, overall, you're going to hear some themes from us that, again, my background was more in real estate before this, and what's going on and what has been going on in the housing market is, to me, very troubling because of how many different types of industries it impacts. So I know I saw somebody on the call here today might be impacted by some of this, that if people aren't moving because of the gridlock in the housing market, they're probably also not buying appliances and those types of things. They're not making necessarily investments back into their house with new carpet or any of that. And so I have some real concerns about the housing market and then ultimately what that could end up happening. But you already see some of those in the bottom left that might not directly be in housing, but it's sort of the second or third step away from that where we're seeing some residual impact.
So given all of that industry momentum or lack thereof, what should we be watching going forward, both in the short term and in the long term, related to, where to grow your business or where there are opportunities or potential challenges? So I think in the short term, the tech rebound. So Jay posted about this, I believe, on LinkedIn a while back. Salesforce returns to boomerangs to reignite their downtown offices and reignite growth. So they had very high profile major layoffs, but are now kind of bringing people back into the fold as they probably realize the talent shortage is putting them in a crunch. Government shutdown. So we put this in the slides a few weeks ago when that was all but certain. And now I think we're about a week away from potentially a government shutdown again. This is just something to watch as it does impact those government healthcare jobs. And depending on how long these shutdowns last, typically there is a long-term impact to those sectors, even if jobs are eventually regained when the government reopens. And then strikes. So far, the very high-profile strikes that we've had this year have seemingly been resolved. But because of a lot of the trends that we'll be talking about in today's presentation, there has been a little bit of a shift in power. So employees are gaining a little bit more power, and we've seen a lot of movement on the labor front. So just something to watch out for as a business to be able to be proactive in those types of the conversations.
Yeah, and then from a long-term perspective, the Bureau of Labor Statistics recently put out a 10-year forecast, and it I think had a lot of really interesting, useful information, much of which I agreed with. One of the things that they mentioned, and this number is a little frightening, honestly, but over the next 10 years, healthcare jobs will account for, I think it was about 45%, almost 50% of all new jobs created will be in healthcare. The number one occupation in terms of number of people working in a job, I think, is home health aides. But obviously, because of our aging population, we'll show you a chart on that in just a second. But it'll be dominated. They mentioned in there as well anything data related. They talked about transportation, logistics, and so on, because of the shift from retail stores to more e-commerce. That many of those jobs they believe will grow. But really, really interesting report. They also highlight the fact that we'll talk about as well that we'll continue to have a labor shortage. We're just, because of demographics, you can see this train coming from a long, long ways away. We're going to continue to have labor shortages. So AI and automation, Josh, I agree with your point there that a lot of it will be automated manufacturing, but there are some things from government investment that could theoretically offset that. We'll see how that actually plays out and how long it takes for some of those jobs to come back. But those are some of the more long-term challenges that we see in long-term opportunities as well. So that kind of wraps up this question. If you have some you'd like to submit in the box, go ahead. Two of the things Chuck asked about the revisions. You've probably been seeing some of the things, the comments that we've had on it. What's been funny is it seems like every month, like a pretty good jobs report comes out. But what they kind of bury is the fact that the good ones from a few months ago, they actually took a lot of those jobs away. So I think Mallory, was it in this latest number, not only was October down from kind of where we had been, but the last 2 months combined were revised down by like 100,000 jobs, I think.
Yeah, that's about right.
Yeah, so things haven't been quite as good even as what's been reported. They're just slowly like chipping away at it. Hey, they're doing the best they can, I'm sure, but that's been an interesting thing for us to watch. And then it was asked at the very beginning, and we're going to get into this topic a bit deeper here in a minute, but it was asked at the beginning, where are you seeing more challenges right now? Is it through retention or through recruiting? A couple points on that. One, so on retention, we are seeing people quit their jobs less frequently now than we did if you go back to what was called the Great Resignation, or there are a whole lot of terms associated with that. But overall, fewer people are quitting their jobs. Again, part of that's because you're not seeing some of the big offers that are out there. There are fewer recruiters. It's been a really tough year for recruiters. So you have fewer recruiters actually going after and trying to poach folks. The ones that are, you see really towards certain industries, at this point that we've already highlighted. So retention's being a little bit less of a challenge than it was. And then in terms of recruiting, now you do have a more active candidates that are out there, and not quite, from what I've seen, not quite the expectation of, candidate comes into one of these roles and their expectations are a notch or two below, I think, what they were when the market was just incredibly hot. So, we'll keep rolling on. If you have questions, continue to ask on the side, and we'll be monitoring them. So, Mallory, why don't you tell us about just kind of the roadmap of the talent shortage and what that's going to ultimately do?
So, phrase this in terms of what trends will impact compensation, and we'll get to that toward the end of this presentation. But really, it all boils down to what the Wall Street Journal deemed a couple of weeks ago a long-term labor crisis in 6 charts. So starting off, demographics. So we've had lower birth rates, baby boomers are retiring, reduced immigration. Lower birth rates means that there are fewer, Gen Z and younger millennial employees filling in for those baby movers who are retiring. That's creating a labor shortage. And part of the reason that unemployment rate has remained low, and why we don't see it increasing much over the next couple of years. So the demand for workers is expected to remain greater than the supply of workers due to some of those factors that we just mentioned, which will keep wage growth above where we had seen before the pandemic. So a lot of the themes I think we've been talking about lately are that things probably won't ever return to a pre-pandemic normal. We're likely to see a really tight labor market and pretty elevated wage growth going forward because of some of the shifts in balance between employers and employees. What's driving some of the demographic changes that we talked about? I think Jay was going to mention this, but when I first showed him this slide, he asked me to triple check the numbers a few times because it just doesn't seem like it should make sense. So the 65 plus population in our country has grown by almost 21 million since the year 2000, while the under 18 population has grown by just under 1 million. So these are the folks that are retiring, and we have a much smaller pool of talent to replace them for a whole host of reasons. The under 18 talent pipeline just isn't large enough to sustain future growth. This is one of the reasons that we see, and why the government sees, a big increase in the demand for healthcare workers going forward, because our population is aging and also living longer. These will cause businesses to change how they attract and retain talent, especially as you're looking for managers, well, a lot of your managers are in this maybe 65 or getting closer to 65 than not, and you're going to have to rely on maybe less experienced or younger folks to pull in to pick up those roles.
Yeah, well, yeah. I was just going to say when Mallory showed this to me, I was like, "There's no way." I know the number's big, but this is wild. I didn't believe it was that big. The other thing, kind of below this, and we'll get to labor force participation here in a second, is once you get beyond 65, you're less likely to participate in the labor force. But also, we saw, and it reminds me of some of the either millennial or Gen Z comment that Josh had, was that we're also seeing fewer people work in their teenage years compared to what we did. So those boomers, a lot of them were working when they were teenagers. And so it built a work habit along the way. Teenage workforce participation rate plummeted around 2000, and it's never gotten back up to where it used to be. So those are, I think, some of the underlying other challenges that are that are playing a role there as well. But on the next slide, Mallory, take us through some of the migration numbers as well.
Yeah, so one other challenge, and migration tends to be a really political issue, but it's also a labor market, a numbers issue. So immigration started really declining maybe 7 or 8 years ago. We've just now started to rebound, which basically matches our 1981 levels. So on a relative basis, we are still not adding as much to the labor force as we were in 1981, and our birth rates are much, much lower.
Yeah, and you'll hear a lot of economists talk about this, that the only way we can that it can be seen, other than automation. I know Elon, I think, said the other day that automation will make it where nobody has to work anymore, but I feel like that's a little ways off. Until then, if we just look at our talent pipeline, it's a real struggle, and this is one of the areas that's being targeted. Obviously, this is talking about the thought is around legal immigration, qualified for work, and so on, that it just, at some point, if we're going to continue to expand or add jobs, you start wondering how we do it without some other factor like this starting to change. And then, I mentioned it briefly just a second ago on labor force participation. Just demographic shifts have really influenced this. So older population, the youngest population not participating as much as they were before. And so the numbers have started to bounce back in terms of, when COVID hit, a lot of people just left the workforce, and it took them a while to come back. We're now back to levels we were. The unfortunate thing is that we just need it to be a lot higher, and that's hard to do based on, again, underlying demographics.
All right. So
yeah, and then I'll take this one. So one of the things I'm thinking about, we're going to get into some of the remote work. We'll have some maps that I like to look at related to that in a minute, but we're going to get on a little bit of how remote work has changed and the number of opportunities, and just fewer companies starting to offer that. When you then pair that up with what's happening in the housing market for people who own a house, and we'll cover that more in depth towards the later part of the presentation, it's made it where relocations are harder to do as well. So fewer remote jobs, relocations, people don't want to do it, especially if they own a house, and what that would mean to try to get another house at today's interest rate. And so I guess the best analogy I can think of is, it's almost like musical chairs were playing the last few years. All of a sudden the music has stopped, and wherever the people they are, that's where they're going to stay. Like that's where they're at. Now, not totally, you'll still have population movements and so on, but there's some challenges there related based on those factors that I just mentioned. So if we now look at, since right before the pandemic to where we are now, which states have really grown and increased their employment base, and those are the ones you see in the darker shades of blue. Which ones have roughly about the same? Those are the gray, and even California is still kind of there in the middle. And then which ones have really had an exodus, and you just either fewer people are deciding to work, or they're moving somewhere else and working there. And so that's where, when I think about it, those in the darker shades, especially for jobs that are on site with manufacturing and healthcare and some of those others, that's where you're going to see more of the talent pool that you actually have more people now. And it's a pretty big divide between the top and the bottom ends of this equation.
And so, in addition to there being disparities with how big the labor pool is growing. For everyone, the labor market remains incredibly tight. Essentially, for every 100 workers, there are 4 who do not have a job and want one, and the pool of workers who are available to work who are not in the labor force is not very large. So there, as of October, there were 3.9% unemployment in the US. Again, very low by historical standards, definitely up from the low of 3.4% we've seen earlier this year. But when you dig deeper into certain types of jobs, it gets even more difficult, especially since these are some of the most in-demand types of jobs and most difficult to recruit for. So legal jobs have an unemployment rate of 1.1%. I think for most of this year, it's been below 1%. And I think for women, it's about 0%. Healthcare practitioners, management, both 1.6%. And we'll get into this later about why that can matter and why that can be a challenge for your recruiting. Really, even business and financial, even in tech, where there have been some layoffs and a little bit more softness, we are not seeing the unemployment rate rise. We'll get into this a little bit later as well, but part of that could be tech jobs are still in really high demand. They just might not be seeing those big pay bumps that they were a couple of years ago during the big hiring spree. We dig deeper into what that actually means. So last week, Jay and I kind of went through, what does this look like for a recruiter? What are the challenges that some of these underlying data points mean in terms of your ability to find a candidate? So let's just say you're hiring an accounting management role in Dallas. So not even an accounting manager, director, senior VP, et cetera, just general management person. There are 9.9 million managers, directors, or VPs, et cetera, in the US. Only 493,000 of those likely work in accounting. Then when let's say we were narrowing it down to DFW, you need someone there. There are about 14K of those, so 14,000 in Dallas, and only 214 of them are unemployed and actively seeking work. Then you have to ask yourself the questions of, do they have the requisite experience and education that you're requiring, or do you need to adjust those? Do they have subject matter expertise in your industry? Are you asking someone with a ton of experience in SaaS and recurring revenue to go work for a manufacturing company that manufactures airplanes or something? Then finally, does your company offer the work setting? Are you remote or hybrid that person even wants? And you're down to maybe a handful of people in the area. This is becoming a very big challenge for a lot of businesses. And we're seeing this play out with our clients as well. That are just like, where are the people?
Yeah, and some advice that we've given is especially if you're starting to get in the management world, management director, VP, so on. The bigger talent pool likely is the ones who aren't quite, like, they haven't been promoted yet. And so when we've described, if you've been looking for a manager and you can't find someone, look at a way for somebody who's that great senior accountant who is ready to take that next step. You're going to have a bigger pool there. Josh asked a question around on the previous slide on some of those rates. Are those just people filing for unemployment? I don't think that's exactly the case. It's meant to capture everyone who is unemployed, whether they're getting unemployment insurance or not. But what I will say is, I think that the point that was made around gig work related to that, I believe probably spot on. The numbers feel lower than what reality seems like. And so I think there is some sort of disconnect in those numbers of really, really low unemployment rates for types of jobs that we know have been pretty impacted, like tech jobs as an example, over the last year. So I do think there are probably some challenges overall in how those numbers are reported, but overall, if you just look at it on a relative basis, some of those are still much lower than what the overall average. So with that, it was brought up earlier around recruiting or retaining people, which one seems to be more of the challenge right now. So we went back and we looked at, the annualized quit rate going all the way back to 2002 and just see what those trends look like. So basically, if you go back to the Great Recession, At that point, because a lot of people, millions of people lost their jobs, and it wasn't like the pandemic where all of a sudden you had a big bounce back right after that. And I know that it took a while to recover all those jobs, but it was actually really fast compared to most recessions. Following the Great Recession, it was a slower climb out of it. We had a sustained period of job gains, but it wasn't as fast as a rebound. And so people weren't leaving their jobs because they continued to be hesitant about what they just saw, play out with the Great Recession, because it's a pretty scary time, if everyone remembers. So people just weren't quitting their jobs, but that kept inching up and up and up. So basically from then until right when the pandemic hit, the quits rate was mostly going up, and then maybe starting to level out there towards the end. In May 2022, that's when kind of that whole Great Resignation kind of hit its peak of 30.8% in terms of voluntary quits. Now, this is the US number, but we stripped leisure and hospitality jobs out. So like restaurant jobs, retail jobs, where you tend to see people move more frequently, we stripped that out. Even this number, for those on the line might still seem high. Some of you might seem a little low, but there are a lot of industries where 10 or 15 or 20% is more of the norm. And so, but this is just take that one that's an outlier out. This would be the aggregate of the rest. So over on the right, you can imagine in a company of 100 people, the ones that are kind of where you see the empty filling, that represents in 2022 on average for those types of industries. That's how many people would have left, and just what a challenge, especially for COOs. Goodness, you're thinking about how are we going to produce the stuff? And if you have that kind of turnover in producing the stuff, it makes it a whole lot harder. If we look at 2023 now, you can see what these trends look like, and likely going to have a little bit of a, if we extend out to 2024, it's probably going to look something like this, except maybe just we'd fill in maybe a couple more people. We're projecting, I think, Mallory, somewhere around 22 to 25%, somewhere in that range, I think, in terms of voluntary turnover. So likely the trend will be moderating back to what it was right before the pandemic would be our best guess. Now, these are voluntary quits in terms of, people being laid off. Mallory, what do those trends look like?
Yeah. So one question, I'll respond to Gerard's question before we move on from this. So this is every industry except for leisure and hospitality. And leisure and hospitality is the real big outlier. I don't have the numbers in front of me, but I want to say they have a much, much higher rate of quits annually than your typical industry, but we can get those numbers over.
Yeah, that can be a good follow-up, because when you start to break it out, it's a pretty wide range. Like, finance jobs, as an example, I think are much lower in terms of quitting. But we can follow up with some of those numbers.
And so when we think about quits, what's the flip side of that? And that's layoffs. So quits are disproportionately high, and probably one of the reasons that layoffs have remained so low is because businesses are struggling with talent retention. So layoffs increased substantially, the middle of last year, following the Fed starting to raise interest rates. We saw high profile layoffs in finance, banking issues, as well as technology. So they've, continued to tick up. If we zoomed in here, kind of the last few months, the second half of this year has looked a little bit more stable. They're rising, but more normalizing than continuing to increase at a rapid pace. So they remain almost still 2 million below where we were from 2015 through 2019. And I wouldn't expect us to get there, over the course of the next year or so. And even if we were at the closer to 2 million layoffs per month, that would still be well within historical norms. So I think, going back to a point that I believe Jay made earlier, businesses will continue to rely on passive candidates. Even though there might be more active ones, going after passive candidates is still going to be a major way to fill your open roles and add new positions if you're in a growth and expansion mode.
Yeah, and then I'll answer Gerard's second question here right after the next couple of visuals, because it'll transition us into the next section, actually. So it's a very timely question. The layoffs number overall, look, when we if you just read the headlines that are out there, like this is the biggest one, I think. If you read the headlines that are out there, they've just been, I mean, layoffs talked about left and right over the last year. And, it seems like most people have probably either you've done it in your company, your friends or family member, you've seen it, people have been personally impacted by it. So it is different. It's just we were at a historic low, and it's starting to get a little bit back in a normal time frame, or a normal level. This gets debated a lot, though, because it feels like it should be way higher. And so is there evidence that we can look at that says, well, maybe this is somewhat accurate? So if we look at the next chart related to unemployment insurance claims, so the claims numbers are actually, and these are harder to dispute because these are actual claims. It's not just based on some surveys that are then kind of, there's some magic that happens somehow, and they go back and make major revisions later. I mean, there are some holes to figure out in this, but this is it's a harder number to argue against compared to some of the others that are being produced. And overall, you can see, where the levels were generally in terms of the first chart looking at initial claims. So this is when someone is first impacted by a layoff, then they go and file an unemployment insurance claim. So just that first time, we monitor that because it gives us an idea of layoffs, because that's when you would start to see some of those happen. You can see that the number, like if you really looked at it and zoomed in, you could see a little bump up there towards the end part, which correlates to the rise from the really depths of where layoffs are really, really low. Layoffs increase, so you see just a little bit there where it increased. Now they're starting to actually come back down. The other number that we look at related to this would be continued claims. So this is after the first time. From then on, as people remain on unemployment insurance, same type thing. We're at levels that were at the lows of the lows prior to the pandemic. And you see the bump there towards the very end where that's where, more layoffs were experienced. And then now it's starting to come back down again as well. So it tends to, both of these tend to say that the layoff numbers being produced make sense. They might get revised a little bit here or there, but it's not like a massive spike you would see during a pretty hard recession. The other one, the one on the right suggests as well, is that when the number coming down also means that people aren't remaining unemployed for a really long extended period of time. That's not the case for everyone, obviously, but in aggregate, it's showing that people are finding work. It might take a few months, it might take longer than that, but it's not dragging out for years at a time. So the question that came in just a second ago was around, has there been a shift in why people are leaving? I think though, I would almost flip it around, and there has been a shift in why people aren't leaving. And some of the reasons why have to do with, we're about to cover it here in a second, but it has to do with compensation trends of not seeing the really, really outlier type pay being offered. Again, you don't have quite as many recruiters coming and poaching talent, and people are a little less confident in the job market today than they were previously in terms of switching jobs. And so those factors are still at play, but the ones also still at play are there are a lot of job opportunities still out there. You have folks that are getting raises when they move. It just might not be as big as what it was. And you have production workers that are ready to be managers, and there's not an opportunity at their company, or they're ready to take that next step up, or they simply aren't a fit one way or another, and they go and explore another opportunity. So some of the things that are, have always caused people to want to transition jobs, those are still at play. I think the other parts are now coming back into balance, and oh, by the way, remote work and fewer options there. So all of those mixed in are why I think people aren't leaving quite as much as they were before. So continue to layer in the questions. I love seeing them. Love the comments coming through. Josh, thanks for those. You've added a lot of great material there. What we thought we'd do, I think I covered this. I think I showed this the last time that I presented, earlier this year or around this time last year, whenever it was. We started showing this around last year and what we expected to happen in 2023, and it's really playing out. So we thought we would bring it back because I think it's still really relevant. Here's what went on. And this goes back to that question that was just posed of why people were leaving and maybe not quite as much now. This looks at, this is conceptual, by the way. So this is a data scientist. If we took the full bell curve of pay in Boston and where kind of, people fit along there, if we took all the data scientists. So what happened in late 2021 into 2022 was you started having companies get really aggressive. They had big growth plans. They needed to hire these workers. everyone heard the stats, twice as many jobs open as people available, and so on. And so you start to see big jumps like this. So to land that candidate, they were looking at somebody who was maybe a little bit below. So early, maybe not even mid-career data scientists, and then offering them like senior pay would command, or somebody who's a little bit further along and they're now offering them top of the bell curve. This represents when you heard that, like, so-and-so got offered, they're making what now at their next job? Like, this represents what happened back then. So Mallory, what did we expect this year? And it's playing out, and I think it's kind of the same for next year, right?
Yeah. So I think for this year and going into next year, what we're expecting is more modest increases, fewer high-paying jobs, fewer people being poached for basically the exorbitant, life-changing salaries that you can't you can't even do a counter offer. So you might see more just annual merit increases, or maybe someone moving for, like Jay said, they're not seeing a management position open in their current job, so maybe they'll take a pay bump and switch roles. We're also seeing a little bit of backsliding. So I recently had a friend in town who was hired by a very, very large social media network during a big hiring spree in 2021, and then was part of their layoffs and has taken another job for a very large coffee company. As a user experience researcher, you can probably do the math there to figure out where. And, this is really what her situation has looked like. And when we talk about what's going on in labor market, she's a person who is feeling like, wow, I was on top of the world. And even though by all accounts, she's, incredibly successful, this still is a lot of pain for her when prices are still going up. Her pay has changed drastically while still having a good job. So we're seeing a lot more of that going on in the labor market, where people that are impacted by layoffs, or maybe even are looking for a different remote or hybrid situation, are ending up at a lower pay rate than they had been before.
Yeah, and I would say the little person on the left side of the screen here, that's like normal. That's what should be happening. Not in all cases, but that's the typical thing. When somebody switches a job or even gets a promotion, it's that kind of movement, not the one that we showed on the slide before. I think that's going to persist. The one on the right, that's the one where it's going to be interesting. I think that's not the long-term thing that should happen, but I think there's still some more of that to play out in the market, unfortunately, right now. But hopefully, as we get things stabilized, you'll kind of see more normal longer-term movements like we've seen. If we look at the next visual, this really starts to highlight that, the whole thing of people switching jobs aren't getting anywhere near the premium that they were before. This is something that the Atlanta Federal Reserve puts out each month. It's a really great tool. I've used it for a long time. If you just Google Atlanta Fed Wage Tracker, they have an interactive tool where, you can look at it by industry. You can look at people if they're switching jobs or staying at jobs. There are all sorts of breakouts that they give. It's really, really helpful. This is, if you look at their job switchers, just that one line, and we're looking at a rolling 3-month average here. You can see how, again, following the Great Recession, if you switch jobs, you weren't getting that much of a pay raise. You might only get 2 or 3% just from going from one job to another. It then got to more of a steady state of around 4% on average. Some people make lateral moves and they get paid the same. Some people, get a nicer increase. This is the aggregate of all that. Look at how the numbers jumped in 2021 and 2022. So people switching jobs were getting paid a lot more. And again, this peaks out at around 8.5%. I'm sure you all know, I know, people getting way higher than that. One of the fun things this time last year, actually, I was presenting at a conference with a bunch of recruiters just before things started to change a bit more with the economy. And I said, all right, everyone raise your hand if you've recruited someone and when they went from one job to another, they got more than a 10% raise, and everybody in the room's hand went up. And I said, all right, keep it up if you've seen 20%. And a lot of hands were still up, 30, 40, 50. I mean, you wouldn't believe as you went along, like how many people's hands remain raised as those numbers got higher. And so this is the aggregate of everybody. Certainly it's been more than that, but look at how much it's dropped recently. And then if we compare that longer term to people staying in their jobs, you can see that typically if you switch your job, you're going to get more of an increase than if you stayed. That's a big reason why people move. But the gap, or two things. One, the gap, but look at how big it was in 2021, 2022. But also notice that what businesses, so when you were approving budgets over the last couple of years, you probably were under a lot of pressure to do more than that typical 2 or 3% increase that you might see in your industry. Again, everyone's a little bit different, but that was around 3% normally if we look back or prior to the pandemic, and you can see it's been closer to 5%. We believe this number is going to start to come down a little bit. We use a little bit different source than what they're using, or a little bit different modeling, so it's not going to be quite the same. But Mallory, if we look at broadly for merit increases, what are we forecasting for next year?
So we're expecting to round out 2023 probably just north of 4%, maybe closer to 4.2% where we've been. That number has really not budged throughout the course of this year. And then going through 2024, expect 3.5%. We might even end up revising this upward to 3.75 or closer to 4%, depending on how things play out in the beginning of 2024. But really, the moral of the story is what Jay was saying. Going back to the typical 2 or 3% merit increases that were really common from 2015 through 2019, those are around the norm, I don't think are going to be enough to cut it if you're having retention challenges to prevent those employees going for the 5% pay bump or so if they're switching their job.
Yeah, and we've seen other surveys of CEOs broadly across the U.S. Their expectation is 3%. So I found that interesting. If you're doing business planning, it says 3%, but the market's really saying 3.5 to 4%. It tells me there's still going to be a little bit of a disconnect. We're talking about 0.5%, but in big companies that means a lot. In terms of actual dollars. And so we'll see, but overall, we do believe it will steady out, but because of the overall pressures, again, remain probably elevated compared to the past. Great question there. And this is actually, we were going to stop and see if there were any more questions. So feel free to ask if there's anything on your mind right now. But do you see any impact on wages? This is from Kat. Do you see any impact on wages since there's more pressure for wage transparency in the job posting? Gosh, there are a lot of layers and angles to the wage transparency. First, in terms of volume, Mallory, how many is it? A handful of states right now are requiring it. And I know certain cities.
It's a handful of states, but I believe it's close. We're getting close to almost half of the workforce in the U.S. being in a pay transparency, residing in a pay transparency location. Because there are some, there's a few towns and cities elsewhere that kind of get figured in as well.
Yeah, and Andrew, this is all related to the U.S. So with wage transparency, it's really interesting. We've highlighted this before in other presentations. Companies are if they're in it. So it's kind of two things: is it legally required or is it strategic? Companies doing it strategically are doing it because they know that candidates are more likely to look at the job if there's a wage attached to it, especially if it's and this will relate to the other point, if it's a pretty defined range. So they look at it and say, yeah, that's the wage I'm looking for. And it gives, I think, an advantage to those companies being that transparent. To be that transparent, there are other kind of pay equity things that probably already need to be in place within the company, or you're going to have some other challenges. But on the other side, where it's legally required, some of the postings we've seen are just laughable. There was one that was like, you're going to make somewhere between 100,000 and $1 million. Or I've seen one between 10,000 and 150,000. They're just putting some range out there that just because they have to. So we advise people what makes a lot more sense, we believe, is have a more narrow range, because it's going to, people are going to, again, be more likely to apply to it if there's a range. But if it's a really wide one, it's almost pointless. The other thing I would say, where we see sometimes ranges that are what I would still consider pretty large, even though they're a bit more defined. So it's between 100 and 150,000. As someone who's ran departments and so on, to me and worked with a lot of recruiters, the challenge I see is that maybe you don't have your role really defined yet, because that can be a pretty different experience or skill set or set of responsibilities you would expect between those. Overall, though, I think it is going to put more pressure on certain companies to have more competitive wages, because it'll be really, really easy to see what the competitor down the street's paying if you're not. And whether you're matching that or not. So yeah, I do think for companies paying under the market, it is going to put pressure on them.
And Jay, I think there was a hand raised from Scott.
Yeah, exactly. So I've been seeing some interesting data points, especially towards the older workers, right? So you mentioned the number of people over 65 versus those who are 18 and under, right? We also saw Josh put a great point in there where, it takes 1.5 new individuals to replace a person that had the experience that left your organization. So my question is there an increase? Are you seeing it in the data, this increase for those who are older, let's say the boomers, to incent them to stay and work longer? And if so, are you seeing a decrease in ageism? Because usually when you get to that mid 50s to early 60s, people start saying, no, I don't want to pay you. I don't want you around. You're too expensive. So I'm trying to figure out, how does this play into this labor market, right? Are the people who are older, do they have more leverage now than they did in the past, because age was taken away their ability to stay and continue to see even the 2 to 3% year-on-year increases?
I think those are great questions. I don't necessarily have data points, or some of them, I don't know if the data points exist, or I don't have them handy, but I think they're all great points. We are seeing people work longer in their career. I think that was a little bit disrupted when COVID originally, because of just some challenges obviously related to that during the pandemic. But I think they're all good points. Honestly, I don't have an answer, other than I do think companies are thinking through it differently, because they're trying to figure out ultimately how do we stay in business and make more money. And I think you bring some great points for it. Yeah, really great questions. That might be actually a topic for you all to continue to discuss after this call and in future meetings. Okay, housing market. I mentioned we would go to this because not only is it my background, but it's something that everybody relates to somehow, some way. I mean, we all live somewhere, and you're seeing, whether you're renting or you own a house or you're thinking about selling it, you're likely seeing some differences there in the market. Josh, I did the same thing, actually. I think I timed it perfectly. I sold my house right before the market really, really changed, and we're renting until we see what all happens out there in the world. And so we'll get into some of the things that are causing some influences, but it's also going to impact the labor market as well, like where people live and so on. So let's start with what's caused some of this. Everyone on the line is very familiar with the Fed was trying to figure out what the heck to do about inflation. It was at a rate that most people that had never seen, at least in their adult lives, just hadn't seen something like this. And so when it jumped up and peaked towards the middle part of last year, early in 2022 is when the rate increases started. We've raised rates as fast and as high as you've seen on record for the pace over the last couple of years. The good news is it has had the positive impact of cooling down inflation. So you can see the CPI, consumer price growth. So that's what us as individuals, when we go to the store, the story I tell is I don't take my kids to go eat fast food a whole lot, but about a year ago, I took my teenage son to one of the places, and it was $26 for 2 meals at a fast food place that was known for their 5 for $5, right? And that's like 5 for $50 or something like that. So it's really had an impact. I've got 3 teenagers, so I really think about the grocery bill a lot. So you've seen that now cool off from 9% down to 3.7%. Now, certain things have cooled off a little bit more than others and so on, but as consumers, it's putting less pressure on us, which then also probably means less pressure to go out and need as big of a raise or look for as big of a raise. All of the stuff. So I think that's also, on that, what's causing people not to quit quite as much. I think that's probably playing a role a little bit as well. Then the producer price growth. So us as businesses, and when we're thinking about the inputs it takes for us to produce our goods, we were seeing prices go up, 11, almost 12%. Middle of last summer. That's now down to almost flat. And so I know that that's not the case in every single thing. A friend of mine is talking about a software that is absolutely vital to their business, and they're getting a 10% increase and they can't do anything about it. It's kind of like healthcare costs. And so there's certain things it's just hard, you can't even do it. So you figure out what else you can manage. But the good news is that's come down a lot. Now, Chuck brought up earlier on the worker strike, and then when some of these things happen and there's some other impact to your expense line that starts to change. So some of the input prices might not, but in certain situations, if you see other prices, ultimately there's going to be a trickle down effect, and it'll hit somehow, somewhere, some way. Somebody's got to absorb the extra cost. And so the good news, though, is we've seen these come down. So now the Fed has the Fed has, kind of paused interest rate increases. We'll see where it goes from here. But Mallory, let's look at some of the damage it's caused to things like mortgage rates over the last year or so.
Yeah. So as the Fed has raised interest rates, I think the most salient thing that we've seen is the increase in mortgage rates for, I'm a long-term renter. Unfortunately, probably not going to be able to get into the housing market anytime soon, especially in Dallas, where we've seen all those people move here. But one other, that has created kind of secondary effects within the housing market. So new single family home sales have started to rebound. That makes sense, right? Because no one has lived in a new home, but existing single family home sales is where we've really seen things start to kind of crater in the housing market, because a lot of folks locked in interest rates in 2020, 2001 at 2 or 3% and cannot afford what that mortgage would look like on a similar house going forward. So we see a couple of impacts. On the hiring side of things, it's going to be harder for homeowners to move if they're locked into a low rate, which might make remote work necessary for businesses that would rather return to office, just because the numbers don't add up. If you can't bring people there, or they aren't able to afford housing in your area based on, getting out of their current mortgage and buying a new home, it makes it really difficult. And then on the industry side of things, we're still watching what's going on in construction and finance, which could be at the risk for deeper job losses as we see this all unfold. Construction has been very resilient, but that's just an area we're watching.
Yeah, and some of the impact that we've seen from it, Mallory mentions there, it's not always just the straight housing market, but I mentioned earlier, like when people move houses, often the current furniture doesn't fit the new place, and so you have to buy something, and so you're helping support other parts of the economy that are kind of attached to it. But then there's the side of, again, will people relocate? So if we go to the next slide and we look at it, workers willing to relocate has hit like an all-time low. We started talking about this again about a year ago, and it's played out exactly like we thought. And you start to see all these headlines pop up of, no, I ain't moving. And so, I think that's especially tough when you're talking about, so someone owning a home, oftentimes it means they've been able to afford a down payment at some point and so on. And often they're going to be a little bit older in life, home ownership, and when people get it, it's just kind of changed over time, but you might be talking about people who are already managers or directors or VPs or something like that. And oftentimes when you're looking for that experience, you might be one of them to relocate. And I've done it myself. I've done it twice over the last 5 years or so. And so it's getting harder to do that. So if you're looking at those types of roles and you're considering that, just know that the person on the other end has different challenges related if they own a house. If they don't, it could still be different. But if they own a house, they have this other challenge. And we'll highlight, we've shown this a lot. People seem to like it and it resonates. We did a simple calculation using Zillow. It's been funny to watch how these numbers change over time. Funny is actually probably a bad word. Sad maybe, seeing how they change. But if we took a $750,000 house back in 2020, 2021, when interest rates were around 3% or lower, like I had one at 2.9, I think. And that 750, by the way, seeing where everyone lives on, where you mentioned where you're from, I know some of you that would be a really bargain of a price, and others it would be really expensive maybe for where you live. So just know that we just picked that rate for the illustration. So 750,000, 3% interest with all this stuff would be around $3,400 monthly payment, which is what matters to like individuals. How does it fit with their monthly expense budget? Because that relates to what they get paid as well. So if I think about, like, we're in Dallas, and if I think about Atlanta, which is a pretty similarly priced housing market for where we are, and if I was trying to, recruit someone to move here, and they're in that $750,000 house, and now, they're going to move here, and not worried about some of the other factors below this that come into play, but if they sold that house, now they can afford a $495,000 house for actually it costs them more per month. Now, it depends on, again, what money they put into it. We're not going to get into that, but just look at the difference. It's like it's hard to imagine how that has changed that fast just in a couple years. And so I don't see it reverting back quickly anytime soon. So again, there's going to be some kind of gridlock there, and I'm not sure how it's going to play out, but goodness, it's certainly been turned upside down over the last couple of years. And so you then combine that with, I alluded to earlier, this shift in remote work opportunities. And if we look back at 2022, and these are some folks who gather this information to look at, the relative number of jobs being posted that either had full-time remote or some hybrid component to it. This is what it looked like. So the darker the colors, the more likely those states were to be offering remote work. That was 2022. And then Mallory, where are we at now?
So for 2023, we see the map has gotten a whole lot lighter. And the states, with the exception of Idaho, the states that are really in the darkest, over 13% of the job postings highlight remote or hybrid work, are states that have generally lost population and lost labor force over the last couple of years, and seem to be relying on remote work for, to fill their talent pool. And when we look at a state like Virginia over there on the right, there are a lot of government, which is heavily distributed. I used to work in federal government consulting, and almost all of our clients were working remote several days per week. Then when you look kind of Rust Belt or toward the South, Sun Belt, there's a lot more manufacturing there, jobs that cannot really be done remotely. And then, just a whole host of other reasons why that might be. But reality is that there's definitely a disconnect between what workers want, which is more hybrid, more remote, more flexibility, and what employers are offering right now, which is more return to office, more hybrid, being in the office 3 days a week, right? It doesn't really make sense for a company to have people come into the office 2 days per week if you're paying for an office for 5 business days per week. We actually just went through some changes like that on our side.
Yeah, so that's, we're getting towards the end here. So last kind of part of this, just to wrap up, would be we'll cover some of the overall numbers that either we expect, or if we look at some really smart economists that are out there that the Wall Street Journal surveys, some of what their expectations are as well. So Mallory, maybe if you start on the labor market side of it, just expectations for next year.
Yeah, so 2024, so their average expectations for annual net job gains is around 800,000. Granted, that ranges from total job losses closer to 2 million, total job gains closer to 4 million, a really, really wide range as we kind of expect from them. But when we dig down to the average, around 800,000, so less than 100,000 jobs added per month. So certainly much softer than what we've seen over the last year, but by no means, terrible. An unemployment rate closer to 4.4%. Jay and I were talking through this. It seems really hard, given everything we're seeing in the labor market right now, that we'll get all the way up to 4.4%. But the fact that we're saying, whoa, it's unlikely, even if the labor market really softens, that we'll get to 4.4%, just shows how low the unemployment rate has been, right? That would have been a really low, or considered quite low and very tight, almost full unemployment rate, before the pandemic. Annual wage growth. So this is our forecast that we showed earlier, about 3.5%. Don't be surprised if that edges up to 3.7 or 3.8 over the next couple of months as we keep watching where those numbers are going. But again, takeaway there is it's still higher than a typical 2 or 3% merit increase that we saw before the pandemic. And it's going to put pressure on companies for talent retention and merit planning. And then a voluntary turnover rate in the 22 to 25% range. So again, this is something that's coming down, puts less of pressure on retention because some of the wage growth has evened out and people aren't seeing those big pay bumps. Jay is going to take this to a little bit more of a macro level and what we're expecting.
Yeah, so just some of the things there. One would be there's actually an economic rule that if the unemployment rate increased that much within kind of around that amount of time, it actually kind of would be a recession, or it would be indicating a recession's on the way. So those are some numbers that conflict. That's why we think the unemployment rate won't quite get that high, but recession probabilities have been consistently been lowered for next year. Even I think the Fed has it at like 0% or something. Like, depending on who you talk to, the numbers have come down a lot. Some of the things influencing that, so the CPI staying, lower. The projection right now is around closer to 2.5%. That would be a good number for the Fed, and be better for the federal funds rate to not go up anymore from where it is. In fact, what's on there is actually, roughly around 0.75 of a point or so below where it is. So that's what these forecasters believe, at least kind of the average or the midpoint, that we'll see some, at least by the end of the year, we'll see interest rates down just a little bit from where it was. The GDP growth is not very strong, but again, a lot of that's going to be based on, I think, inflation starting to come down where it was. I think it was Josh that mentioned 800,000 annual net job gains just in AI. Wouldn't necessarily disagree with that. The overall challenge related, and that's really part of it, we just don't have the people. Like, it's hard to model in sustained 2 or 3 million jobs added. Now, somehow we've kept kind of doing that. Like, we did it when I was forecasting back. I knew some really smart people forecasting back in 2013, 14, 15. They're saying the same thing, and we just kept plowing through it and somehow kept adding a pretty good clip of jobs. But we're at this point where it's just really hard to get the numbers to work, to figure out, we don't have the talent pool to actually do 800,000 AI jobs, even if there were that many available. Long term, though, that is going to be one of the fields that continues to certainly grow relative to other ones. But that's kind of the big picture rate, of some of the numbers that we see there. And I see with some questions coming in, we'll go ahead and wrap up with our last slide and see anything else to be answered there. So just, broadly, these are some of the summary of things that we've talked about today. We still have really low unemployment rates. We don't have a ton of talent. Wages are starting to stabilize a bit and maybe get a little bit closer to what they used to be in the past. And you can see some of the other ones there. So I think big picture, it looks like a soft landing is happening. Where the real difference is going to be is once we get into each of your individual types of companies, at that much more granular level, that's where we're seeing a variety of outcomes. And I think that'll probably persist into next year as well. So with that, we'll answer any questions that you have. If you'd like to connect with us again, we have the contact. If we don't solve everything here, you can contact us via LinkedIn as well. So let's see, we do have one in there. If unemployment's low and people are less likely to relocate, and employers are less likely to offer remote, does that mean employers are lowering their standards, hiring less quality to fill their open roles? I think, there are a lot of good points there that from an employer standpoint, and let's not factor that people are poaching our people. From an employer standpoint, if you're only limited to the people right around in your local neighborhood, then by definition, you're probably, you're not necessarily always going to get the best talent. The best talent might not be locally. And so in some, there could be some impacts there. It's probably just going to depend on the type of work and what that real difference and gap is. Tech tends to be the one that gets brought up a lot because there can be such a variance in where those people are located in the exact type of skills and experience that they have. So some industries probably a little bit more susceptible to that than others.
And then I see a couple other questions. There was one from Fermin of average wage growth by state. I haven't looked into that recently, Jay. Have you seen much on that? But it also depends on to Jay's point earlier, the kind of the breakdown of the types of jobs that are most common in that state. But
yeah, a great question. I don't have it right in front of me, but it's a great thing that we can research and put out on LinkedIn here in the next week or so. And so I'd say look out for the material there, and then we can also forward it over to the COO forum for distribution as well.
And then similar to Gerard, I don't have the numbers for specific industries or locations in front of me, but we can get that out. I know I've got it somewhere. All right. Less qualified, but more trainable workers. I think that's obviously the goal always. And I think I've heard from a lot of our clients, or through our client success team, from a lot of our clients that are more focused on training right now, because that's the way that they are getting people to fill the roles that they have open.
Yeah, and I'd say both for new hires as well as promotions or advancement within the company, especially because if you already know they're the right person for the company, they're a great culture fit, they're doing a great job, but they might not be qualified for that next role. That's where I think companies have used better strategies to try to fill it. And then you don't have to go outside and pay recruiting fees if you have an external recruiter. And there's a whole lot that's good about somebody who's trainable for that next level up. And that's all we have. We can hang on. I know that we're almost at the top of the hour for the allotted time, but can see if there are any final questions from you all. And thank you so much for being so engaged.
Yeah, thank you.
Yeah, thanks, Josh. Laura, we can just turn it back to you, and Mallory, if you want to stop sharing, and we can wrap it up from here.
Actually, I'm going to give it to Chuck and let him close things up.
Oh, sure. Great. Thank you. Well, first off, thanks everyone for joining us on this snowy Friday. Special thanks to all of our veterans who may be on the call, or if you've got friends and family who have served. Thank you so much for that. Also, thank you, Mallory and Jay, for joining us today. You always just hit it out of the park for us. Leaders are learners. So if we're not learning and understanding all the inputs that go into our business, we certainly have no ability to control the outputs. And as COOs, that's important to us. So thanks for everyone that taking the time out to learn today. So our homework assignment for this weekend, pretty simple. You're going to get an email, most likely, I think, from Laura, maybe later today, or maybe Monday, maybe who knows when it's going to come out. But make sure you're connecting with those folks on the call today, fellow members, and I know we have a few guests as well. But make sure you're connecting with people that you see today. I think it makes us all stronger as a community. And then the other part of the homework is to reach out to LaborIQ on LinkedIn, follow their newsletter, follow them, connect with Jay, connect with Mallory. It's always great to be connected to smart people. We need more of that in our lives. So again, I'll just say thank you to everyone taking time out today. Have a wonderful weekend and be safe, and see you on next month's call. Take care.